Hey, 7 Ways to Wealth family. In this video, we're going to be talking about asset allocation. What is asset allocation? Asset allocation is where you allocate your entire investment into different sectors of the market or different financial markets. So let me give you a quick example. If you want to allocate your funds to different financial markets, you would do 20% into the stock market, 20% into the cryptocurrency market, 20% into the foreign exchange market, 20% into real estate, and 20% into a high yield savings account for an emergency fund. So all of that equals 100% of your investment. Now, you can also do this in the actual financial market itself. So in this video, we're talking about the stock market. We're talking about index funds. So we are going to give you an example of what asset allocation looks like in the stock market. So asset allocation is you balancing your portfolio to outweigh your risk. You want to be as less risky as possible. So you want to allocate your funds appropriately. And in the stock market, we are basically comparing stocks versus bonds. Bonds are very safe, but they yield a lower return. Stocks yield a higher return, but they're considered risky. Do you want to be at a 50% allocation, which means that you own 50% of stocks and 50% of bonds? Or would you want to be around a 70-30, where you own 70% of bonds and 30% of stocks? You have to determine your specific asset allocation based on your age as well. It's very important because if you are closer to retirement, then of course you want to secure more equities in bonds. But if you are less closer to retirement, further away, then you want to secure more of your equities in stocks. So now when it comes to index funds, there's a certain asset allocation that is vitally important in order for you to implement so that you can get the highest return. And this asset allocation is brought to you by David Swanson, which has part of this Ivy League school's endowment fund, and he grew it from 1 billion to upwards of 17 billion in a short period of time. So let's dive into that specific asset allocation, which is what I highly recommend, which is what I do. So as far as index funds and the most appropriate asset allocation, there are 6 different asset classes that you want to invest in. Asset class number 1 is domestic equities or indexes that are domestic, which is here in the United States or whatever country you're in. Second one is international indexes. The third one is REITs, real estate index trusts. The fourth one is emerging markets. The fifth one is intermediate treasury bond. And the last one is inflation protected bonds. So those are the 6 classes that you want to allocate your funds appropriate to. Now, let's talk about the percentage, because are you going to even it out and do, let's say, 15% for all 6? Or are you going to balance it appropriately to your age? So I recommend that you balance your portfolio appropriate to your age. So I'm going to give you the recommendation for a 30-year-old. And all you have to do is the most appropriate calculations for your age. So let's dive into the most appropriate asset allocation for an average 30-year-old. I want to be aggressive when it comes to index fund investing, passive income, and growing my wealth. So I am going to allocate 30% of my total investment into domestic indexes. So that is my actual total stock stock market, and that is companies that are here in the United States. Number 2, I'm going to also allocate 30% of my total investment into REITs. REITs are the real estate investment trusts that are publicly traded on the stock market. These REITs are companies like Public Storage, hospitals, malls, shopping plazas. The REITs actually own these commercial units, and you are actually considered a real estate investor passively. You don't have to go knocking on people's door to collect the rent on the first of the month. Number 3, I want to allocate 15% of my total investment into international indexes. Those are indexes that are bought into companies outside of the United States. Those are companies like Mercedes-Benz, Samsung, Alibaba. Next, I want to allocate 15% into emerging markets. That 15% is going to go to markets that are smaller, like Taiwan, markets like Dubai, smaller markets that are up and coming. Even China is actually considered an emerging market. Number 5, I want to allocate 5% of my total investment into intermediate treasury bonds. Why? Because I want to play it safe. And as we all know, we consider whatever the government is backed by is pretty safe. The last one, number 6, I want to allocate another 5% of my total investment into inflation protected bonds. Inflation is at its all-time high. Right now, it's at 7.9%, which is the highest it's been in the last 40 years. Is it beneficial for you to invest in inflation protected bonds? Absolutely, because your money stays valued the same. It doesn't matter if inflation rises or if there's deflation. That $300 that you put in there is still going to be valued at $300 versus $290 or $280 or $270. So you want to consider that, because we are playing it safe. We're not gambling with our money. This is not that type of investment. So now let me give you an example with actual number. Let's say that my total investment is $1,000. So that means that 30% or $300 is going to go to domestic indexes. Another 30% or $300 is going to go to REITs. $150 is going to go to international indexes. Another $150 is going to go to emerging markets. $50 is going to go to intermediate treasury bonds. And lastly, you only have $50 left. That $50 is going to be allocated specifically to inflation protected bond. So this is in just what asset allocation means and how you are going to create a balanced portfolio for yourself. Now let's dive into the specifics of what funds we're going to invest in. I'll see you in the next video.